You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Well, we're back again with another week, and wait, I think that's how you started it last time.
Probably.
I think I just started it the exact same way.
It's going to be the new intro.
Well, we can roll with that.
To be honest, we're even going to be talking about some of the same stuff as what we were talking about last week. I imagine we'll start by talking about the markets. So it's going to be, you'll be like, wait, haven't I listened to this already?
Yeah,
it sounds like same topics, but the numbers will just be slightly worse this week.
Yeah, well, I mean, it's certainly more interesting than when the markets are kind of just like chugging along. Yeah. It's good to have something to talk about.
Yeah, that's true. How many podcasts have we done where it's just like, all right, America's up by 1% for the week, Australia's up by 0.7%, and yeah.
Yeah, exactly. And it's kind of funny. The moment we stopped doing indices is the moment indices actually kind of became interesting.
Got interesting. Yeah, that's hilarious. And now it's like the thing that we've been talking about for the past 3 weeks.
Yeah, it's all we do. All we do is indices now. Welcome back.
Yeah, welcome back. Indices podcast. A little bit of feedback for the podcast. So we've covered fishing recently, but we haven't covered the weather. So people have been asking. So I guess the first thing I'll ask you is, how is the weather in Melbourne at the moment?
The weather is great, actually. I'm loving it. It was last week was really bad, and I thought we're starting to head into cold weather, and I hate cold weather. But this week's been really good, up in the 30s,
not
close
a fan.
to 30. So
yeah, I hate cold. I'd much rather warm weather than cold weather.
Me too.
But then again, I live in Canberra, so
how is Canberra?
Oh, Canberra's good at the moment. It was like Melbourne last week where it was just raining.
Yeah.
Rainy. But man, Canberra winters, it's just so horrible. I mean, it's just something else. Like getting up in the morning when it's 10 degrees is doable, but getting up in the morning when it's like -5 degrees is just like, I just don't want to do it.
I don't know how you do it. Yeah. I wouldn't even get up.
Well, I just don't get up, yeah. I just slowly slug my way out of bed at 10 o'clock and get over to my computer and turn the heater on.
I mean, we've got lots of stuff to talk about today. Of course, we will talk about this week's what's been happening in the markets, continuing on with the coronavirus stuff and all of that.
Don't say that word, Hamish.
Don't say the word.
That's all right. We don't make money from the podcast anyway, so we can say it all we like. We won't get demonetized.
Yeah, we can't monetize it anyway.
How crazy has that been? The YouTube has just been cracking down. They're literally demonetizing anything that has coronavirus in the title or mentions coronavirus in the videos. It's ridiculous.
Yeah, I don't get it at all.
What? How does that break community guidelines? I have no idea. How does it break?
I think it must be the controversial issues or something like that. That must be the line in the. But yeah, it doesn't make any sense.
Yeah,
as to why you shouldn't be able to discuss that. I mean, I can imagine that there would be a small portion of those videos that are not advertiser friendly, but if 99.9% of the videos around that are news related and they are advertiser friendly, it just seems real ridiculous. And it's even more ridiculous because we can just avoid it by not saying the word. I mean, I made my video and I just said the event instead of coronavirus.
I called it the beer virus.
The beer virus. Yeah. Heineken virus. Yeah.
You know what's kind of funny is that I just tried to look it up as to why YouTube was demonetizing it. Like, how did it break the community guidelines? And I actually just found an article that was released about 3 hours ago saying YouTube today announced a change in policy regarding the novel coronavirus or COVID-19. Previously, YouTube prevented monetization of videos that included the word, and apparently now they've just lifted that.
Oh,
The creator community was unhappy with YouTube's decision. Well, yes, I mean, that's literally what we're just talking to demonetize any video featuring discussions of the coronavirus.
Wow.
Today, YouTube CEO Susan Wojcicki explained the company's decision to reopen. What did she say?
You know what? We need a soundboard for breaking news. Like,
Yeah.
breaking news. We were wrong for the first 5 minutes in this podcast.
Yeah. There's been a lot of discussion around monetization on videos about COVID-19. To better support the sharing of information, we're enabling ads for content on the virus for a limited number of channels, expanding to more soon. Oh, okay. Well, that's barely helpful.
Useless.
Yeah.
Anyway. Before we get into all of this discussion, we should get to our sponsor
Yes.
for today's episode. So this episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using for over the past few years, over the past 3 years, to track the performance of my stock portfolio. And it is just fantastic for keeping track of your capital gains, your dividends. If you have dividend reinvestment plans, it will do all of the calculations for you. Currency gains, if you are buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out your capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. And that is site spelt SIGHT, sharesight.com/young investors. And if you use that link, you can also get 2 months free when you sign up for a yearly subscription. So go over and do it. Get your 2 months free.
Do it.
Do it.
Palpatine quote in there. Good Star Wars quote. Got to try and slip more Star Wars quotes into the podcast. Man, you should watch me watch like Star Wars Episode 4. I can quote the whole thing.
Get right into it.
Yeah. That's a trivia topic that I'd do pretty well at. Yeah.
Okay.
Anyway,
interesting.
Let's talk about stocks.
Let's talk about stonks.
Let's talk about the stonk market.
I guess we can sort of just start with what the markets have done.
Yeah.
Recently. So you had some stats here. So you run us through.
Yeah. Well, I was just looking at now how far the markets have fallen, and the S&P 500 is now down 19% since the 19th of Feb. So it's a pretty decent decline now. And then here in Australia, the ASX 200 is down 20%.
Right.
And since about the same time, the 20th of February. So, yeah, we're starting to see the markets actually fall pretty substantially. However, like it's funny what we were talking about during the week just to each other is that even with these market declines is that there's still a lot of stocks that are still very expensive. So I think I hope we've kind of got some ways to go yet, but classic Young Investors podcast fashion, we'll just have to wait and see.
Yeah, I think I mentioned that in the video that I posted on Saturday, which was that...
Oh, did you?
Yes, while the markets are down 20%, and I mean, the Australian market's now in a bear market, which is considered 20% or more.
Yep.
Many of the stocks that I want to look into are still higher than they were a year ago.
Yeah.
So they've gone up maybe a ridiculous amount. I mean, you can see one I can think of is Apple, for example. I think it was up 80% or something ridiculous in 2019. So for it to come back just a little bit really isn't enough to make it attractive. It's still substantially higher than it was a year ago. And if I wasn't happy buying it a year ago and the earnings of that company are more or less the same, then I still want to see it come down a lot.
It's like what we were talking about. We mentioned this probably like a month ago, 3 or 4 weeks ago, is when we were talking about the S&P 500, how much it had gone up, or maybe it was even early, maybe it was last year, I can't remember. We're talking about how much the S&P 500 had gone up, just the price of it, but we're talking about the earnings of the S&P 500, and generally the S&P 500 earnings had gone basically nowhere. In fact, when we were talking about it, this was after Q3 2019, they were actually on a downward slope for earnings, for the average earnings of the S&P 500 companies. So, yeah, you're right. Maybe it's a case of the market price is just correcting itself from being just stupidly overvalued, but it's not now getting into a place where it's what you might consider it to be really cheap.
Yeah, definitely. And I mean, I've been picking up bits and pieces of stocks over the past couple of weeks. Actually, I've made a couple of different investments. But yeah, I mean, there's many businesses that I think are fantastic businesses, but their prices are just not low enough
too high.
yet. And I mean, I presume like if this stuff is going to continue to go on for another 6, 12, 18 months, which I think is very likely at this point, I don't think this kind of problem is going away anytime soon. We would probably expect to continue to see more problems in the stock market. So I'm personally hoping that markets continue to struggle over the next year, and maybe then some really great businesses that generally attract really high prices can become a lot more attractive.
Yeah, come back down to earth. No, I agree. Did you see the circuit breaker kick in the other night?
Yes. Yeah.
Were you watching that, or were you asleep?
I wasn't watching it. I was asleep.
No.
Yeah.
I stayed up. I stayed up because I wanted to see. That was after oil went down 30% in a day, based on the breakdown of the OPEC deal and a price war starting with Saudi Arabia and Russia. And then the ASX dropped by 7% in a day. And then the futures in the US crashed down to their circuit breaker of -5%. So we just had to wait and see what would happen when the market opened. So I was staying up that night and watching what happened. But yeah, so the US market has got these market-wide circuit breaker rules where essentially it just pauses trading. So it forces the entire market into a trading halt if the S&P 500 loses a certain percentage in that day. So, for example, there's a couple of different levels. So if the S&P 500 drops 7% in that day, then the markets, as soon as it hits that 7% drop, the market halts for 15 minutes. And that's the one that we saw happen just the other night.
Yeah.
But there's two further levels. So there's then a level 2 circuit breaker, which is the 13% drop. If it hits 13%, then again it pauses for another 15 minutes. And then level 3 is a 20% drop. And if it drops 20%, then the market's just shut down for the rest of the day.
It's kind of funny because it's kind of funny. A 15-minute break. It's like, everyone calm down.
Yeah.
Relax.
It's literally what it is. It's just everyone like take a breather.
It's like a 15-minute timeout. Like,
yeah.
Bad. Yeah. Bad traders. Bad.
Yeah. Stop. Yeah. No, that's true.
But yeah, I mean, people just panic. And I remember I was coming home from where I was away over the weekend on Monday, and I was in the car and I was just refreshing the All Ordinaries in Australia. Yeah. And it was just ridiculous. It was at 5% down, refreshed 5 minutes later, it's 5.5% down. And it just kept going down to, at the worst, I think it was maybe 7.7% or something down. And it was just insane. I'd never seen anything like it. Yeah. It was kind of exciting, but very scary for a lot of people.
Yeah, no, definitely. Oh, well, I guess, I don't know. I mean, it's so difficult to predict, obviously, what's going to happen in the future. But I guess there's a couple of arguments that have been floating around. I'd be interested to see what you think is most likely. The one argument that I've heard is that this is about as far as the market's going to go, and then we're just going to see it charge back up, like this is just a small correction. But I mean, the coronavirus cases, I was looking at this, coronavirus is only like getting stronger at the moment. There's now almost 150 confirmed cases in Australia. And this could, like, if it keeps spreading, it could be, well, we're already seeing it start to be a decently impactful economic condition. It's obviously impacting a few specific industries, which I'm sure we'll talk about. But I wonder how quickly does the market price in the potential for this to get much, much worse? Like, is it already pricing in the fact that the coronavirus might see us have a couple of negative quarters? Or, I don't know, do you reckon we might see it go down, if it worsens? Or...
Yeah, I mean, I think there's no doubt that this coronavirus thing is not going away in the next 6 or 12 months. I mean, most experts think that we're at least a year, probably 18 months, maybe even 2 years away from a vaccine. So this is not something that's going to go away soon. It's just a matter of how deep's the impact going to be on businesses. I mean, we've seen Italy, which is in complete shutdown.
Yeah,
is
that's
that
right.
going to happen in other areas? Is that going to happen in the US? If there's areas of the US that are in complete shutdown, I mean, that's not going to be positive for the markets at all. So I mean, the answers we don't know. We'll find out. Yeah. We'll find out next week or whatever our catchphrase is. But
find out next year.
But yeah, I don't see how this is just something. I don't see how this is an event where the market just crashes quickly and goes back up. I think that it's going to, I imagine that it would at least hover around where it is for a while, maybe go down if things get worse, maybe go up a little bit. But we haven't seen any of the effect on businesses yet. We haven't had any reports come out.
No, we're going to have to wait.
We know we've got initial reports out of certain companies having to cancel certain things, such as the airlines canceling flights and blah, blah, blah. But we haven't seen any numbers come out yet.
True.
And we're going to see that over the course of the year. Yeah. And I mean, I don't really know, but I don't know what to say, but I hope it, I kind of hope is kind of a sustainable one, because what was the last time we had a 17% drop at the end of 2018? Yeah. And it was really, really quick. It was kind of just it was a really quick drop.
Yeah. So I hope that we hope that no one gets hurt by the coronavirus, but
of course,
we kind of hope that at least we get opportunities to invest in high quality businesses that really don't have, well, in a lot of cases, don't have anything to do with the coronavirus. So I don't know. It's just going to be an interesting 6 to 12 months just to follow. And I think the real time where things could get interesting is what's maybe in a month and a half, when companies start recording their first 2020 quarter performances.
Yeah, I guess it would be in the next month, 2-3 months. It must be next month and a month to 2 months. The companies will start reporting, so that'll certainly be interesting. That's also where a lot of companies will upgrade their guidance, or downgrade, I should say, more likely downgrade their guidance, which is very, very heavily relied on by analysts and fund managers. So when companies start coming out and saying, "Hey, we're not going to grow at 8% anymore. We're going to grow at 2%," that'll
tank the prices. Yeah. And that's probably where you find, maybe if there's a freak out from Wall Street over downgraded guidance, that's where you might see margin of safety prices. You could see them hit quite quickly, I would imagine.
Definitely.
So what industries are we looking at? I think we talked about this a little bit last week. What industries are getting hit hard by the coronavirus? Well, I think this week we've continued to see more of the same. I think we're just seeing anything that's to do with travel is getting hit pretty hard. We've seen, obviously, the airliners. They're really they're struggling with this coronavirus. Obviously, there's just less people flying to and from overseas, that sort of stuff. And also, as we were talking about last week, we're seeing that now reduction in even domestic flights. So I think airlines, cruise lines, obviously we've seen massive reductions in the cruise liners. We've seen literally 50% reductions in some of the biggest cruise line companies in the world. I think you just did your report on your platform about Royal Caribbean, right?
Yeah, so I was having a look at Royal Caribbean, doing a bit of an analysis, and I think in many ways it's a great company, but one thing that concerns me is the amount of debt and the amount of not just debt, but other kinds of liabilities that they have. So one interesting component of cruise businesses is that they collect deposits for the trips, for the cruises up front, and then they supply the cruise later. That's pretty normal. It's the same with flights and that sort of thing. You pay up front and then you go on the flight later. And as a result, while Royal Caribbean or other cruise companies hold those deposits, they have a liability, they have an obligation to provide that cruise in the future. Otherwise, they have to give the deposit back. And Royal Caribbean is one of the companies that has quite a substantial amount of these due in the next 12 months. They have $3.4 billion in customer deposits for cruise voyages that should be completed in the next year. And one of the things I was analyzing when I was looking at this company was what happens if 10 or 20% of those voyages can't happen.
True.
And then they're on the hook for, well, if it was 10 or 20%, you're talking about $340 million, all the way up to $680 million that they have to return. And they had about $250 million in cash. So $700 million in having to pay back deposits is going to be heavy. They're going to have to take on debt to cover that. So, I thought that was an interesting aspect to look into cruise businesses, and maybe I'll make a YouTube video about it, because I know that a lot of people are really into their cruise companies on YouTube at the moment. I think just because of how much they've fallen. And while, yes, they are great businesses, they've been around for many, many years. I think Royal Caribbean was initially founded as Royal Caribbean International back in the 60s or 70s. So they've been around for a very long time. They've been through many recessions. But they also do still operate with quite a lot of debt. So,
a very capital-intensive business, I suppose.
That's the other thing, is not only are they involved, not only do they take a lot of money up front for these cruises, they're very capital-intensive. They're spending hundreds of millions of dollars in some circumstances to build these new cruise ships.
Yeah, I think I was looking at their one of their most recent ones costs more than $1 billion. Like they're top of the line. Like I know a couple of their lower down ones cost, I think, like $300 to $400 million to build, but I think their latest one cost them over $1 billion, something like that. So you can imagine. I mean, that's kind of, in one aspect, that those costs is why this kind of industry has kind of that barrier to entry advantage. What we were talking about off air before, the top three, you're saying the top three companies in the industry hold 80% of the market share. Just because if you're like, have you ever heard of a startup cruise ship company? I don't think so. Just because the cost to entry is so high, like just to buy one boat, it costs you nearly $1 billion or something. So it's kind of a positive like that, but also in this case, it could be a negative as well.
Yeah, definitely. I mean, if you could be a decent sized cruise company making $50 to $100 million in profits each year, it doesn't even come across your radar to think about building a $1 billion ship.
Yeah, exactly right.
Which is what I think it was Royal Caribbean that was working on that. Maybe it was Carnival, I'm not sure, but it's a very high barrier to entry industry. And even the big players, they rely heavily on quite a lot of debt to maintain their lead.
Yeah, exactly.
So it's not even only that they're producing so much cash that they can build these huge ships, they're still relying on substantial amounts of debt to fund those capital expenditures. So very, very tough industry. Those businesses are getting hit substantially. One that I saw recently was Boeing was down 18% overnight. 18. That's not 80. Sorry.
Yeah.
For those
18%.
who can't understand. Can't
hear it.
Can't understand the Australian
It's always
accent.
hard like that. It's like 17. Yeah. Wait, did you just say 70 or 70?
Yeah.
17.
Yeah.
Wait, what? 18%. Boeing went down 18%.
Yeah, that's it. No, so they were down big. I thought that was interesting because for quite some time after the, the 737 MAX? So that plane had a bunch of issues. I think there was about 350 people who died or so relating to issues
crashes
with those planes. Yeah. But the stock really didn't go down that much. Kind of just hovered around. But now it is down 57% from its peak. So they're starting to get into a bit of trouble. Basically revolving around the fact that they're so heavily they have a lot of debt.
Yeah, right. Right.
So, yeah.
Yeah, man, for a company like Boeing, that's just like adding insult to injury. With the whole airline, like they're obviously not an airliner, but with the airliners dropping as well, you'd imagine they'd probably be requesting Boeing's business a little bit less, and that plus your 737 MAX issue. I mean, that's just nasty. Yeah, I think they didn't go down too much from the 737 MAX because even though it was obviously a huge issue, they didn't see a big decline in the orders that they had. So it was more like just like a delay as opposed to oh no, we're not going to buy that anymore. But yeah, I think we've covered most of them. Have we got any others? So we got cruises, airliners, any company to do with travel.
Yeah.
I guess the next thing I wanted to talk to you about is, or ask you about, is with all of this going on at the moment, I suppose, what are you particularly focusing on while the markets are going down? Not necessarily like what stocks are you buying. I don't.
What are you buying?
Yeah,
Hamish?
I don't want us to talk about that. But
Yeah.
like, what are
No, I
some
know
of
what
the
you mean.
things to be focusing on as an investor when the markets are going down so much like they are at the moment?
Yeah, well, I think one thing that this whole event sort of brings to light is how important it is to look at companies that have low levels of debt. Because while, yes, Boeing, many other big brand name companies, if you just eliminate the debt problem, yeah, of course they'll be thriving in 10 years because this problem will be gone. This problem will go away. It's not going to last forever, and people will come back to buying from the big brands. But debt is in the equation because they have to survive through that period.
Right.
And this might be 1 year, it might be 2 years where their earnings are substantially less than what they were expecting. And they have these debt payments coming up, and beyond having to make the debt payment in maybe 3, 5, 7 years, whatever their term is, they also have the interest payments that are becoming a larger burden and restricting them from making other cost-saving initiatives and other investments and that sort of thing. So I think that's super important. And I mean, there's been a couple of businesses that, we're going to continue to see more and more businesses go bankrupt, not be able to make their debt payments. As a result of this problem and other problems going on. One that I saw recently was, do you know the company Kiki K?
Oh yeah, what do they sell? I
Yeah,
know
so
the
it's-
name. I forgot. What do they sell? It's like stationery or something.
Yeah, it's basically stationery, calendars, and journals and that sort of thing.
Yeah.
But they're a really popular business, quite a relatively small business. I think they do about $80 million in revenue.
Yep.
Or they did, I should say. They had about 450 employees, but they recently went into administration, so they were unable to make their debt obligations. And the founders basically said that it was a cocktail of events that are going on. And that's usually what happens is they have trouble competing with online shopping, and then the coronavirus causes a softening in demand, and then there's other things going on in other areas. And it's kind of this combination of events that cause them to not be able to make their debt payments. And yes, this kind of event is rare, but as an investor, you still want to be out of companies. You do not want to be involved in companies that even have the risk of losing you all your money.
Yeah.
It's the number one rule of investment.
So I'd be interested to explore this topic a little bit more. So we're saying low debt companies. So I guess we're talking a lot about looking at companies, say cash flows, and also their numbers on the balance sheet as well. So I'm wondering, so for me, when I'm looking at financial health of a company, when we're talking about bankruptcy, the potential for not being able to make debt payments, I guess the numbers that I like to look at are definitely like what their cash flows are leading into the issue that they're facing. Also looking at their current cash in the bank levels, because that's their cushion, and then also then considering how much debt they have and what their interest expense is. Is that kind of, are they the numbers that you're looking at as well? How do you kind of go about when you say you're looking for low debt companies? How are you looking at those financial statements, and what are the numbers that you're really focusing in on?
Yeah, so there's probably three things that I focus on. One is comparing short-term assets to short-term debts. So if you look on the balance sheet, there's two sections. There's current assets, current liabilities, and then there's non-current assets and non-current liabilities.
Yep.
So the current assets and current liability section refers to assets that are going to be turned into cash within the next 12 months and debts that are due within the next 12 months.
Right.
So that's a short-term view of things, looking at things that are due in the next 12 months. So I like to look at that. The ratio you can use is the current ratio, comparing current assets to current liabilities.
And that's just current assets divided by current liabilities.
Correct. And I'm generally looking for this to be above 2 or at the very least above 1, which tells us that they have enough short-term assets, they have enough inventory, they have enough cash, they have enough short-term investments to cover their obligations that are coming up in the next 12 months. So that's one thing I look at. I then want to compare, I do a debt to equity ratio, which basically looks at their overall debt, their total liabilities, all of their obligations, and compares that to the amount of equity in the company. Again, seeing can they cover their total obligations is more or less what we're looking at with that.
Right. Mm-hmm.
And then the other thing I also want to look at is what you mentioned is comparing their cash flows to their debts and the interest payments on those debts. So if their cash flows drop 50%, can they continue to pay those interest payments? And not only can they continue to pay those interest payments, but when is the debt due? Is there maybe they can cover the $50 million in interest payments for the next 3 years, but at the end of 3 years, if they have to make a $2 billion debt payment, then can they afford that?
And this is stuff that you can look at too, by the way, just to interrupt, sorry. And you can definitely, if you go into a company's annual report or quarterly report or whatever, these are all numbers you can look at. They should do a detailed description of their term debts. Their term loans that are coming due and when they have to pay those back, and all that information is in those reports.
Yeah, and I guess I just after you said that, it just reminded me of another thing that I look at, which is when we're talking about debt, we need to relate that to management and how management does management have a history of being able to pay off those debts effectively? So this is another reason why I like a management team that's been at a company for a really long time, because we can look at their track record. We can look back to 2008 and see what happened. Did management load up on debt and then they had to sell a bunch of assets and they kind of messed up the business, or were they prepared for that kind of event? That's another thing I look at. I look at the history of management. Do they have a history of loading up on debt and putting the company at risk? Or are they always very cautious about using debt? And whenever they do use debt to maybe make an acquisition, are they immediately trying to pay that down? So that's another thing I sort of look at.
Cool. No, that's good. So so Kiki K just couldn't pay their debts. They'd just gone bust, have they?
Yeah.
Going back to what we're talking about.
So. I mean, they were so popular. I was really surprised by that. But
here's another one. I got another example here. Boosted board. You know boosted boards?
Yeah, I do.
The electric skateboards. Yep. They're unfortunately going bankrupt as well.
Oh no.
So their CEO released a letter to the community, I think only a day ago, and it said, I've got the exact letter here. It says, "Dear Boosted riders, today we had to make the incredibly difficult decision to let a significant portion of the Boosted team go. We understand this news will come as a surprise to many of you, but unfortunately, developing, manufacturing, and maintaining electric vehicles is highly capital intensive, and over the last year and a half, our business has faced an additional unplanned challenge with the high expense of the US-China tariff war. It says here the Boosted brand will continue to pursue strategic options under new ownership." So that's pretty sad because you see I know a lot of the YouTubers, the big name YouTubers, love riding around the states on their Boosted boards. So another company bites the dust, like what we were talking about before, can't pay its debts or whatever, and this time it's due to not the coronavirus, but for the US-China trade war. So
yeah, I feel like they got a substantial amount of free marketing just from Casey Neistat.
Definitely.
So I wonder if that because he doesn't really post on YouTube anymore. So
I wonder if that did he certainly isn't seen riding Boosted boards much.
Exactly, yeah. I wonder if that made a difference. That last line of what you wrote there is also very interesting, that they're under new ownership. So maybe they sold the business and then the new owners are kind of like, we just have to kill off this Boosted board section of the business.
Or maybe they're just looking for people, anyone that wants to buy them at the moment. I don't know. But yeah, pretty sad. I kind of like the Boosted boards. I've never ridden one because I'm not much of a skateboarder. But just another example of a company going bust. Man, we seem to have a fair few reports, a fair few news articles in this podcast of companies going bankrupt. It seems to happen quite frequently.
Yeah, it's definitely picking up.
And I think we're mainly seeing the Australian ones going bust.
True. Yeah. I would expect that we're going to continue to see a substantial amount more businesses go bankrupt this year, especially if this stuff sort of continues on.
Yeah. What should we talk about next? What do we got?
we should talk about.
Oh, here's something to talk about. The government, Australian government, is finalising a coronavirus stimulus package, economic stimulus package, which is interesting. I'm not quite sure, full disclosure, we're recording this on Thursday the 12th, and I'm not exactly sure whether they've actually announced the details of this plan yet, because I got on this news article, it says, today the government, this was released today, so today the government will announce its stimulus plan. And then in the same article, it's got heaps of details about the stimulus plan. So I don't know how much of this has been actually confirmed.
Right, okay.
But essentially, I'll just read a couple of points. There are actually a few points to talk about. So it says here, the government will splash $6.7 billion over 4 years on tax breaks and subsidies to help Australian small businesses keep running amid the coronavirus outbreak. The stimulus package set to be announced today aims to keep Aussies working as the global virus crisis takes its toll on businesses and financial markets. So, under the plan, the government will offer small businesses up to $7,000 each quarter for every apprentice in wage assistance to retain existing apprentices and trainees. The subsidies are expected to reach around 117,000 apprentices and are worth about $1.3 billion. And a couple of more points here. Businesses with a turnover of under $50 million will have access to a tax-free payment of up to $25,000 to help boost cash flow. So it's estimated the measure will cost $6.7 billion over 4 years, benefiting almost 700,000 businesses and 7.8 million workers. The government will also spend $700 million over 4 years to expand the instant asset write-off. Businesses, new topic. Businesses that pay salary and wages will receive a minimum $2,000, even those not required to withhold tax. So there's a lot to unpack in there.
Yeah.
But I don't know. What are your thoughts just generally on the government kind of stepping in, and do you think it's necessary?
Yeah, I mean, I think government help in these sort of times certainly can help on both sides, whether it's putting more money in everyday people's pockets so that they can spend some more, and then also on the business side, making sure a lot of businesses don't go out of business because, I mean, I can see how a lot of people would see that, this is sort of beneficial to big corporations only, but if lots of businesses are able to stay afloat, then that means a lot of people keep their jobs and those people will continue to spend in the economy. So I think that, I mean, no one really knows how these things, whether they will have an impact or not. I mean, everyone loves to, I mean, I'm sure the Liberals are saying, hey, this is going to be great. And then you've got Labor and maybe the Greens saying this is going to be terrible. But we won't really know what's going to happen with it.
It's all political at the end of the day.
It is. And yeah. I mean, they both have their incentive to argue each side, but of course, we'd love to see that this is very helpful in the future.
Yeah, exactly.
One of the things that I thought was interesting was the increase in the instant asset write-off. So basically, if you don't know how this works, generally when you're buying, so at the moment for this financial year, if you're a business that has turnover of, what's the turnover? Less than $50 million. So if you're a small business, more or less, you can do instant asset write-offs of up to $30,000. So if you bought a piece of machinery maybe for $10,000, rather than having to pay depreciate that as tax over maybe a 5-year or a 10-year period, you get to instantly write that off. So that's a huge benefit to small businesses.
Handy.
Yeah, I know I've used it a couple of times this year. I bought a computer.
Nice.
Which was good because without the threshold being at 30,000, then I would have had to sort of depreciate that and get the tax benefits over multiple years, which is kind of annoying. But they actually raised it to $150,000 and for businesses up to 500 million.
500 million,
in turnover.
So there you go. Yeah, well, I think I feel the same as what you do. I hope that it has, hope that it helps, really. It'd suck if they spent all this money and it didn't help.
That's the thing is,
just be a waste of time. Waste of money.
Yeah, ultimately, we just don't know how efficient it's going to be.
But you raise good points. Like a lot of people argue against this, but at the end of the day, if you're helping out businesses, I think a lot of people just kind of in the back of their mind, maybe they aren't switched on to economics and and business and that sort of stuff. They kind of just have a general sense that, businesses are evil kind of thing, which I can kind of understand because of how much crap you see about businesses doing the wrong thing in the media. But that's the other side of the coin, is that businesses employ a lot of people.
Yeah.
They give money to their workers through their salaries. They help people pay for their own personal mortgages and their own food on the table and that sort of stuff. So, and a small business is an important kind of more vulnerable part, important but more vulnerable part of the economy. So I can understand why there's a push to help small business get through what could be a tough time if we see some worse economic conditions with the coronavirus. So.
Yeah, definitely.
Yeah.
It's fascinating for me because prior to running my own small business, this whole sort of side of small business stimulus and that sort of thing was completely off my radar.
Yeah,
it was just something I never thought about. Yeah, it was.
Well, why would you? Yeah, there's no reason.
Exactly. It's interesting that it's now relevant. One thing I did see this morning was, and this might be really interesting to a lot of people listening to this, is that Yahoo Finance did an interview with Warren Buffett. Must have been a couple of days ago. Actually, they did this. But the whole interview is not out yet, but they're sort of releasing snippets of it, and I presume they'll continue to release snippets and then eventually the full interview on their YouTube channel. So you can head over to the Yahoo Finance YouTube channel if you want to check that out. But in the clip that I saw, they were speaking with Warren Buffett about sort of just comparing this sort of event and his experience with other events such as the 2008 crisis and the 1987 crash. And more or less, Buffett said his classic thing that he says always. He said that, he first said that 1987 and 2008 were both worse than this event so far. But then he said his classic, these events are unpredictable, but they don't hurt you if you have low levels of debt and if you have cash available to purchase assets at fair prices.
Yeah, that's it. I love it when Buffett comes out and does these interviews in times like this because he's just so rational. It's just like all of the interviewers ask him these frantically odd questions. Oh, what do you do? Everything's going bankrupt. What do we do? Coronavirus is going to kill the whole world. And he's like, dude, just calm down.
Yeah.
Just have a sensible head on your shoulders and you'll be fine. It's kind of like a juxtaposition between the general market sentiment, because the interviewers are just following the general market sentiment because that's what the questions that people are asking. So it's like the difference between the general market sentiment and then what Warren Buffett thinks, being that ultra long-term rational investor that buys businesses, not stocks. He's like, calm down, have cash, low debt, buy assets for the long term, competitive advantages, good management teams, find ones that are at margin of safety prices and just keep holding and holding and holding, like what he's done with basically every stock in his portfolio.
I turned on CNBC this morning and it was just, I got a headache. It was just, this company's this leveraged and this happened over the past 2 days, and it was just it was just go, 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 go. And I was like, wow, I need a detox for a sec. So I switched over and put on a Warren Buffett interview, and it was like,
it's so much nicer.
Just relax.
This makes so much sense.
Use your cash to buy cheap assets. It's like, wow.
Hold them for a long time and get rich.
It's
yes, Mr. Buffett, but what's going to happen tomorrow? I'm freaking out.
But the futures.
Yeah, the futures are down, Buffett. The futures are down.
The VIX, man, the VIX is VIX has got to be one of my favorites. Wow, the volatility's up.
Oh, yeah.
So what?
Oh, my gosh. Volatility. Oh, dear.
Oh, no.
It's not like volatility might actually help us see some better share prices on good companies. I wouldn't mind a bit of volatility. I like volatility.
Gee.
Anyway.
It's a crazy world.
Yeah. So what's the deal? So he hasn't finished, or they edited this video in 2 parts or something?
Yeah.
Say only part one's out or something.
Oh, well, the clip I saw was 3 minutes long, so I'm guessing the interview is probably half an hour or an hour.
Oh, okay.
So they haven't released the other clips from it yet.
Oh, right.
Generally, I think that's what they do. So they release 3-minute clips, bit by bit, and then they release the full interview.
And then the whole thing.
So
right, okay.
we can probably expect that over the course of the week. And yeah, as I said, check out Yahoo Finance YouTube channel if you want to get access to that. I probably wouldn't subscribe because they post about 100 videos a day.
Oh, I know.
And it would kind of destroy your subscriction box. So don't do that. But
no, I don't subscribe to any of those. I mean, I just feel like their content strategy is a bit. Well, I guess it's not. They're not really going for subscriptions. They're just going for views. So that makes sense.
Yeah, they're going for awareness, more or less, of the Yahoo Finance brand. Yeah,
exactly. So of course you're going to get 1 million videos a day. Some will get 0 views, and some will get 100,000. Some will get 1 million. Yeah. But it's just all about pumping out content, I guess, for them.
They should have 2 channels, though. They should have the channel where they just pump out every tiny snippet of news that comes across their site. Yeah. And then they should have another one
like a curated one.
Yeah, exactly. Yeah. One that's a little bit more curated. Maybe they have a host that controls it more or less like a normal YouTube channel, because that's more appealing to people who are on YouTube more regularly.
Yeah, absolutely. Yeah.
Interesting.
Should we do some Q&A? Finish off with some Q&A questions?
Let's do some Q&A.
All right, sure. Where should we start? You start at the top?
Yeah, let's start at the top. I'll read this one to you.
Sure.
So this question is, I have a question about currency, hedged versus non-hedged ETFs.
Yeah.
I am in Canada and I would like to buy the S&P 500 iShares after a good correction. Can't decide which one to choose, and I came across different options. Any thoughts?
Yeah, well, I didn't really understand much about currency hedged ETFs, so I did a little bit of digging. Obviously, we can't provide any financial advice and suggest different investments for you, but I was just looking at classic Investopedia, trying to read up, and what do they say here? I'll read out what they've said here. So it starts with posing a question: why would an investor buy a hedged ETF? Aren't ETFs broad enough to avoid uniformity in the first place? So ETFs offer diversification, but a standard ETF that invests in foreign markets won't do a thing to protect you against currency fluctuations. Currency hedged ETFs do protect you against the exchange rate hits. So from what I could understand, currency hedged ETFs will make sense if your dollar is rising and your ETF has international exposure. And then normal non-hedged ETFs will help when your dollar is falling. So for instance, if I've held an S&P 500 ETF over the past few years from here in Australia, I would want it to be non-hedged, as the Australian dollar has weakened and the US dollar has strengthened. So therefore I've made a return in both the investment, but also a return in the fact that if I pull that money back to Australian dollars, then we get a lot more Australian dollars for our US dollars. So, but I think on the other hand, if you're, say, in America where your dollar is very strong, you probably want that currency hedged ETFs, which protects you against your dollar tearing up and away from all the other currencies if that ETF you're looking at has international exposure. So,
right.
Does that make sense?
Yeah.
I don't know if I've explained that well.
No, I think you did a good job of that. And I mean, currency isn't something that I think is. I don't think currency is something that is very predictable.
No,
I think that
I try not to stress about it.
No, I personally know that living in Australia, I'm very likely going to be almost always investing in the US or Australia. And as a result, I just hold a little bit of both. US dollars and Australian dollars. And there's all these different kinds of fancy hedged, non-hedged funds and ways that you can sort of deal with currency. It's not something that I personally am involved in. So I couldn't give any sort of good answer in relation to this question.
I just did a little bit more digging. I'll just read this out because they kind of try and explain how they actually work, because I just didn't understand how they worked. So it says the concept is simple. In some cases, a currency hedged ETF can be nothing more than just a normal existing ETF. So same components, same proportions, same expense ratio, but denominated in something other than US dollars. So obviously this is an American site. The fundamental difference is that the currency hedged hedged ETF contains positions in currency forwards, which are essentially futures contracts on currencies. Forwards allow you to lock in the price of a currency today regardless of the eventual fluctuations. So it sounds like, for all intents and purposes, it's like the same as a normal ETF, plus they use the currency forwards to negate the impact of currency fluctuations.
Yeah.
That's what it sounds like.
Yeah. The very simple everyday person way to think about futures contracts and the way that most of these hedged things work is you're more or less buying insurance on a particular asset. So if currency moves in a way that you don't expect, if it moves in the way that you do expect, then you lose a little bit. You pay a little bit to have that insurance, more or less. But if it moves in the way that you didn't expect, you're protected. You benefit from that contract. So that's the kind of easy, simple way to think about how that would work.
Yeah. Cool. Okay, let's move on to this next one. Here we go. Next question for today says, interested in your thoughts, what your thoughts are on the recent market drop that has been caused by fears of coronavirus. My perspective, coming from an Australian GM, general manager of a small Chinese manufacturing facility, is that we've already been opened back up and we've been manufacturing for 2 weeks. And basically what I feel is that it's all just hype. So it will hurt large companies' bottom lines as they need to pay staff salaries despite some staff still not being able to return. But I think this is a short-term issue which can be capitalized on. So my question is, what companies should we be looking at and which are going to face short-term pain that will give us buyers a fair price? I guess we've spoken about this kind of a bit already in today's podcast.
Yeah, we did. One thing I did have to add that I didn't speak about before, actually, that will be interesting here is that, yes, there are certain travel-related businesses that will get hit the hardest by this because they're directly impacted by this, but almost every industry will be affected by this if it leads into a global recession. And I guess just to address sort of the statement that you sort of made about your personal perspective, that may be very well, but to me that's just very anecdotal, and I still would hold the belief that it's very unpredictable what is going to happen, how long it's going to last. So I wouldn't rely on what you see in your immediate environment to make opinions about where the global economy will go in the future. I would just want to say that first. The second thing is
I was going to say, mate, you might be in a good position to understand, to do more research and understand the context of maybe similar businesses, whether they're also going through the same thing, are they still shut down or are they going back up? You might be in a good position to do more research about similar businesses that are manufacturing in China. So that's all I was going to say.
True, that is true in relation to specific businesses. I guess what I was sort of talking about is like
I get what you're talking
affect
about.
The global.
I totally get what you're saying. I'm just saying that you're in a unique position where maybe you could have some insight into more businesses in that area too.
Definitely. And the way that I see it is that if there's job losses in the travel industry, so those businesses are suffering, there's job losses, then the people who worked in those industries will be spending less in other industries, which will lead to job losses in those industries, and so on and so on and so on. So that's how a recession develops out of a specific industry, which means that even though travel businesses may be impacted the most, this will, if it goes into a global recession or a US recession, this will impact almost every industry. So to me, the most important thing is stick to areas that you understand, like you said, areas that you have a bit of inside knowledge on, areas that you have an edge in, and just make sure that those businesses are in a good position to ride out a period of weak demand. Do they have low debt? Can they survive through some short-term trouble? And focus on those businesses rather than sort of looking to particular industries just because they're hurting the most would be sort of how I would come at it.
No, I'd agree with that. I actually jotted that down as something that we should be doing, is not being tempted away from our circle of competence at times like these just because you see particular industries you don't understand just going down like crazy. Should we finish up there, do you reckon?
Yeah, I think we should. We're pretty much closing in on an hour and...
nice.
Yeah, I think I wonder if we'll be back talking about similar stuff next week. I guess we'll probably have quite a bit of overlap to talk about next week, and going by the strategies that we like to use when we're investing, we kind of hope that the markets continue to suffer, at least in the short term. Thanks everyone for listening. And what were you going to say?
I was just going to say, I want more businesses at margin of safety prices.
More cheap businesses.
I mean, it's just been so long.
Yeah.
I mean, how long have we been just like analyzing these companies, and it's just like, well, nope, that's not going to happen anytime soon.
Yeah.
Just like, oh man, I really like this business, and the price.
Nope.
Come on.
Nope. Yeah, so true. No, but thanks everyone for listening, or listening. You're not watching, you're only listening this
true.
week. And
but next week.
What?
Next week you might be watching.
Oh, really?
Or are we going, like, how are we going to do it? Because next week I'm in Melbourne. So we're going to be doing a live podcast again. Should we film that one? Should we try film it?
I think we should, yeah.
Okay. We'll have to figure out the logistics of that, but hopefully we can get that done and up by Saturday. Jeez.
Yeah.
We'll figure that out. It's all just dawning on me now of the logistics of that. But stay tuned. We've got one coming up next week, and then the week after we should have a pretty cool podcast, I reckon. So we'll have to wait and see about that one.
Yeah.
How's that for a cliffhanger? Jeez, I should write novels.
Lots of exciting things happening. Big thanks to our sponsor for this week. Again, Sharesight.com/young investors if you want to try it out for free, and then you can get 2 months free when you sign up for a yearly subscription. But I think that's just about it. Thanks everyone for listening, and we'll see you next week.
Bye-bye.